You could be wiser as an educated advisor. Hello everyone, I'm Steve Savant, syndicated financial columnist and money color commentator. On today's show, all financial products have expenses. Part 4 of our series on cash value life insurance and tax-free income. All here on Let's Get Down to Business. Almost all financial products have costs associated with them with management and marketing. So you have to look at all products all in. So whether it's life insurance, whether it's mutual fund, ETF, REITs, whatever you're buying, you always have to look at the associated costs and make sure they're disclosing everything. Remember, sometimes you don't have to disclose certain costs, but the client should still know what they are. So if it's not even recommended or required, just remember, if there's any expenses that are above and beyond what you have to disclose, I say disclose them all. Then you're safe and they always know what you're doing, and of course, you'll look like you have integrity. Now, I want to talk about some of these products. Fund expense loads, mutual funds and ETFs. I have mutual funds. I have ETFs in my retirement plan. And I look at all the funds. Now, most people, when they're looking at mutual funds, are going to look at the expense ratio that has to be declared in the prospectus. And if you're using an RIA, he may be charging or she may be charging you maybe a point, somewhere either 25% less or 25% more, somewhere in that vicinity. So let's just say it's a point. So if you're getting a point for your RIA, so somebody can oversee your qualified plan or your mutual fund, and you're also having to pay, let's say, the average fund cost right now is around 75 to 80 basis points. Most people think I have 180 basis points in and that's it. But in truth, if you take any mutual fund or any ETF and you actually ask for the statement of additional information, it'll actually disclose to you all the costs previous under the 12B trailers, the frequency costs, all the interior costs, and shockingly, the average statement of additional information for most mutual funds is right around 130 to 140 basis points. That number does not have to be disclosed to the client, but I say if you're going to be in this game as a man or a woman of integrity, you need to disclose everything. So I'm disclosing now the statement of additional information. Now, the reason I'm being kind of a tough guy on this issue is because for years, RIAs and people who sold securities always were battering the life insurance their life insurance counterparts because we had all these expenses. And we fully disclosed them in all our illustrations. But they did not disclose, and I was at a major BD speaking at their largest OSJ, which was over 100 and something people in the room, and I brought up statement of additional information and nobody knew what I was talking about. So it's important that if you're selling this, mutual funds or ETFs, you need to know the expense ratio, what are you charging through your ADV if you're an RIA, and you need to look at the statement of additional information and also calculate the cash drag on your mutual fund or on your ETF. The only reason I bring up cash drag again is that most people that are sitting, if you're a mutual fund and you have to settle at the end of the day under the NAV, the net asset value, you may have to look at cash drag. If I'm sitting in a turbulent market and I have a lot in cash right now because I'm a conservative fund manager, though that cash position is paying very little, like maybe 0.12, 12 basis points, but I'm still getting my expense loads against it. So you got to remember, I might be negative and it could be costing me, the average is around 80 basis points for cash drag, just to have a cash position. So just keep in mind, all these add up. If I have 80 basis points for my expense ratio, if I have 100 for my IRA fee, if I have another additional 133 to 140 points on statement additional information, and I have 80 basis points on cash drag, all this adds up. And in a non-qualified scenario, I might even have taxes even on a loser fund. In 2015, from August 2015 to the end of the year, many Americans lost money in in mutual funds and ETFs. It was a bad 4 to 5 months. But keep in mind that people who were non-qualified, they didn't do any tax harvesting the year before. So what happened was in the new year, they received their statement and they saw in their statement that they had a negative return. But they also then about a week later got a 1099 on the same fund. So the same fund, even though it was a fund that lost money, on the other side of the equation, they were paying taxes on it. The average tax on non-qualified mutual funds could be as much as a point. So you could be all in on the non-qualified side at 5 point something. Think about that, not 5 basis points, but you could be at 5.17% in total costs on a mutual fund. It could be that high. And you also want to look at the qualified plan. I wouldn't have the tax issues during accumulation, but during my accumulation, I still have 401k expense loads and, administration costs that I have to pay. So when you look at this, I'm in a nickel, either way, qualified or non-qualified at least, that I'm paying on most funds, and I just want to make sure that everyone understands that. And so when I'm teaching this, I just want to make sure I disclose it. Even though 5 years ago we instituted the 408B2 that was supposed to declare all expenses and funds, not every single administration from 401k's administrator are declaring these. So you have to really sort out who's fully disclosing and who isn't. So don't really rely on that. And if you're doing buy term and invest the difference against mutual funds, remember that if I'm going to put an expense load in here, I'm also going to put in my equation my term insurance premium. So when I look at all these numbers, I'm trying to get a calculation of all the expenses on an ETF and or a mutual fund. Now, for decades, as I said before, registered reps and IRA manufacturers have pointed out the cost of life insurance, and I don't deny it. That we pay cost of insurance, we have policy fee, we have to pay administration costs, and depending upon what type of chassis it is, there could be ancillary premium charges. I fully admit it. But when I come to retirement and I'm holding, I have these fees that I have to talk about. I just mentioned them: policy fee, administration expense, premium load, cost of insurance, loan costs when I start to take money out, and if I'm in VUL, I might have I will have sub-account management costs. I'm going to disclose all of those expenses, and I'm going to look at it. My illustration expense in general terms, if I'm trying to compare life insurance, dollar cost averaging or an annual contribution to mutual funds or ETFs, I'm going to look at this in general terms, and the crossover year for the average fund is between 12 and 13 years. A little sooner for mutual funds, a little later for ETFs. So when I'm looking at this position, if I had to have liquidity and I had to have it under a decade, I can't sell life insurance. I just can't. I don't have the time. I need liquidity. But the moment I cross over that 13th year or so, I am off to the races. And my total expense loads, especially if you manage it, and I'm going to show you a little bit about that, if I manage the actual contract, I can bring the costs way down and be extremely competitive from the 13th all the way out. And during distributions, I should be sitting there right around a point, somewhere either north or south of a point, all in expenses, if it's managed correctly, on my life insurance chassis. And when I'm looking at it in accumulation design, I have to look at it because I'm trying to make the most money out of it I can. And to do so, I have to look at the 1982, 1984, and 1988 legislation. All these three changed our life. And I came into the business during this decade. So when I came into it, we used to have first in, last out. Now it's last in, first out. And then in 1984, we invented and constructed the DEFRA corridor, the difference between the cash value and the actual death benefit. They established a corridor. And then in 1988, they said we couldn't do single deposits directly into life insurance any longer, or it would be treated from a tax point of view during income as an annuity. We had to learn how to go around that under the 7-pay test or the CVAT rules, cash value accumulation test, to see if we could actually build a policy that could be tax-free under the new TAMR regulations. And so when I'm talking about life insurance, I'm always looking at the best possible cost of insurance, the best person that I can do it, and that's why I'm going to be selecting the right gender, the right age, the right underwriting classification, and also, if I have to, I might have to use a surrogate insured, someone in the family where I can use a justification. I still have economic justification. And lastly, remember when I came into the business, there were only smokers and non-smokers. Now there's super preferred, preferred plus, preferred, standard plus, and standard just in the non-smoking arena. So it really matters to manage what carrier is going to give me the highest. The higher the classification, the lower the cost of insurance. And that's the game we have to play to make this competitive with mutual funds and ETFs. So I manage the minimum death benefit. I purchase the TAMRA minimum death benefit. I do the guideline annual versus the CVAT test to see which one gives me the better number. I use level or increasing death benefit option depending upon what gives me the best rate of return. I know when to switch options back before I go to distribution, again, to keep my costs down. And I want to reduce the death benefit under DEFRA, never actually crushing the corridor or infiltrating the corridor. I always want to sustain it as an insurance product and not as an investment product. Don't forget to watch our next segment on the 4 cash value policies. part 5 of our series on cash value life insurance and tax-free income. And keep in mind, before moving forward with any of the ideas on the show, always check with your tax consultant, legal counsel, or compliance officer. And don't forget to subscribe to my consumer show, Steve Savant's Money, the name of the game. Daily content that you can post on your website, social media accounts, and database distribution. I'm Steve Savant. Thanks for watching.